My name is Dominique Pfrang. I'm the senior manager for our real estate, M&A, and corporate finance team here in Frankfurt. And I was asked to talk a bit about the general market sentiment, to provide some food for the panel discussion afterwards. And I was also asked to talk about what investors like at the moment, what they don't like, what they are concerned about. And I thought, okay, what are people doing when they are concerned? They typically start Googling. So what I did is I used Google Trends. I don't know if you know that tool, but it's great actually. Google Trends gives you the possibility to get access to the data that was collected by Google on search inquiries starting from 2004. And it provides you with the overall number of search inquiries for a specific topic that you're looking for, and also about gives you some information about the relative amount of search inquiries. So I typed in one of the most buzzing terms at the moment, real estate bubble in Europe. And this is what came out. So starting from 2004 up to yesterday, more or less, we see more or less a flat line and then a sharp increase, especially in the end of 2019. This peak, the biggest number of search inquiries for real estate bubble in Europe was on the 30th of September this year. And I thought like, okay, oh my God, I missed something. There was something terrible happening and I didn't get it. No, it was not that terrible, but the UBS launched their real estate global bubble index. So this is why all the people typed in real estate bubble in Europe. Nevertheless, we have this increase starting somewhere already 2012, and then it got more and more. And I thought, okay, I have to double check what is a typical reaction. Bubble, okay, we should sell. So I typed in sell real estate. And this is what came out, an increase. It got more and more, and now I was getting concerned. And I thought like, okay, should I sell off my grandmother's house or whatever? And I said, okay, it might be a confirmation bias. I should double check and type in buy real estate. So this is really what drives the market and what drives people's minds, not only professionals, of course, but also the typical guy that owns a little flat or whatever. So even if people are concerned about bubbles or they think about selling real estate, what really is in their minds is buying real estate. Those were search inquiries from everywhere in the world except Europe. So this is quite interesting. Enough of Google, talking about some underlying. So where does this come from? We are in a situation somehow where people have the feeling there is some risk in the market, but they are still keen to invest in real estate. So, of course, one thing that drives this is the gap still between the 10-year bonds and the prime office yields here for Germany and UK. A friend of mine is a researcher at ECB and he is focused on real estate, and he told me that a healthy gap between those two is around 250 to 300 bips. So if we have 3.6 or 3.5, there is still a buffer between. The same goes for UK, for Japan, United States, this is a bit narrow. So if this is healthy, I'm not that sure. On a European scale, this gap is also apparent. So this is an average from Europe. So we see this gap again, and we also see that the Euribor is really an all-time low, more or less. And the question is, where does it go? When we were talking last year around the same time, people were quite critical. They thought like, oh no, it might go up, like in 1 year time or 2 years time, we will see an increase. In spring 2019, they said, no, it will stay that way, at least until the end of this year. And now we have September, October. The European Central Bank has tightened the penalty rate for bank deposits. Instead of 0.4, it's 0.5 now. At the same time, they said that they want to resume those bond purchases. and even the US Federal Reserve has cut its key interest rate. So when I was talking to my friend from the European Central Bank, he told me that they are already discussing that there might be, in the long term, a new equilibrium interest rate. That the overall relation between the demand and the supply of money is different than it was in the last years. So what is the outcome of this? Of course, transaction volumes increased since 2008 or 2009. And we think that this will stabilize. So we will stay at a high volume throughout 2019. Figures are looking good, and for 2020, I would suggest that this will stay that way. It's interesting to see where, especially for Germany, the money from cross-border investments is coming from and where it goes. So I think what's interesting is that China seems not to play that big of a role. So the interest of Chinese investors really declined during the last time. However, what is underrepresented in this illustration is the Korean part of it. So Koreans are quite active at the moment. This is what we are realizing in the market. As well, money coming from Singapore, but those investors typically invest with the help of asset managers, investment managers, and this illustration or this statistic behind the illustration does not cover that. So I would suggest that Korea and as well Singapore is quite underrepresented in this. So where does the money go? It flows 50% into office. Residential is also interesting, and retail as well, but the majority really goes into office. So this is more than 50%. I've already mentioned what are investors' concerns right now. We differentiate between two main areas. So the one are economic risk factors, the others are social risk factors. And those results are already from our emerging trends study, which is coming out on Monday, but I'm not spoiling, it's just a teaser, so this is not the full information. The full information you will get on Monday. Nevertheless, the most important risk factors on the economic side are really coming from the real economy. So it's not the financial markets, it's not really the issue, it's really coming from the real economy. Construction costs going up, or the level of construction costs at the moment. European economic growth, there's some doubt in which direction this will go, as well, of course, the availability of suitable assets. So those are the top three concerns of investors at the moment. I think the social risk factors should not be underestimated. Political instabilities, or the perception of political instabilities as a risk for investments in Europe, have never been that high throughout all the last years in our emerging trend study and in other studies as well. So this is really a new factor that comes in. When we were talking about political instability some years ago, we were thinking of, I don't know, like the very, very east of Europe or somewhere in the south, no one knows where. But now we are talking really about the middle of Europe, and investors also have quite a critical look on Germany and what is happening here, and the results of the last elections. Of course, this also contributes to this result. So international political instability, the conflict that we see between USA and China, first and foremost. But as well on a European or national level. So what are investors' favorites? At first, talking about asset classes. Number one, logistics. In the last year, this was our number two, rank number two. Retirement, assisted living also went up one rank. So this is highly sought after. And here we have again this co-everything topic, co-living, co-working, and so on. It's also highly sought after. Private rented residential, also interesting, and student housing. Those are the top five from an asset class perspective. I think the overall tendency shows that that investors are looking for return, of course, and managed properties. This includes all of those co-working, co-living, and so on models. Those provide the necessary equipment and the necessary triggers to get more out of a property. I can effectively manage it. I can go into the value creation chain and really pull the right triggers to get something for my investment. When we're talking about cities in Europe, number one, Paris. It was not on our top 5 list in the last year, so this really went up. The same goes for London. So the overall skepticism of investors regarding London has really gone down. They see, again, possibilities, opportunities in the market, and I think the overall confidence regarding UK has gone up again. Berlin stays interesting. The same for Frankfurt and Madrid. Has gone down a bit, but it's also in the top 5. I thought, okay, those are investors' favorites, and I thought again about this UBS bubble index. And I thought we should compare it. So the investors' favorites and the bubble risks, they obviously have some overlaps. So there's only one exception, Berlin. So it's really in the focus of investors, but at least UBS does not see a bubble in Berlin. However, for all the other European cities, and I have to say, those ranks like 7, 5, 9, 17, doesn't look that bad. It's like, yeah, okay, but the UBS index is globally. So those were also the top 4 European cities in this global ranking. So it's not that good as I first thought. Wrapping it up, what can we do? Where should we invest? So we as PwC see some potential in large office space, because we still see the gap, or I would say the time lag of rental growth in Germany. The large offices that we have in most cities are highly under-rented, and of course, this is something that investors can benefit from if they are willing to put some effort in it. There might be no easy money on the streets right now, so you have to have a good investment management, asset management to make good use of that. As well, niche products, co-living, micro-living, industrial, those are interesting asset classes where investors have a tendency towards. So they are highly interested in that, and we think that those products, due to their high level of management needs and management intensity, are interesting from a return on investment perspective as well. Development joint ventures, mezzanine, also becomes more and more interesting. I think Germany especially is lagging behind a bit. We should have a look at the Anglo-Saxon markets that are much more advanced in this regard. And the same goes for platform deals. So when foreign investors are coming to Germany or to Europe in general, and they really want to get a grip and a foot in the market, this is a very attractive strategy, trying to acquire an existing platform, use this one as a deal sourcing machine, more or less, and then build from there. So this, from an M&A perspective, is a highly attractive strategy, and we already see some private equity investors that follow this approach.